Hey everyone, welcome back to the Economic Analyst channel. In this video, I'm going to go over the quarter 2 2022 GDP report and analyze some of the aggregate data and extrapolate what that means for our economy for today and in the coming quarters. So real GDP contracted again for the second consecutive quarter in 2022, and it contracted on an annual basis by 0.9% after contracting on an annual basis by 1.6% in quarter one. Usually this means that the economy is in recession, though this is not the official technical definition. There really is no official definition for recession, but I tend to equate recession with a contraction in the economy, meaning that less goods are being produced, less goods are being purchased, less goods are being sold. And that's technically what's happening right now going on into quarter one and quarter two 2022. So whether we get a growth in quarter three or not is immaterial. Whether unemployment stays low or starts rising is really immaterial. The economy on a real term basis is contracting after expanding in quarter 1, 2, 3, and 4 for 2021 at exponential rates and then slowing down in the latter part of 2021. Now it's actually contracting in 2022. The major component of this has obviously been the higher inflation rates. The higher prices have been eating into the production process. Now we're producing less goods. Now we're consuming less goods. The Biden administration likes to cite that the unemployment rate is historically low, but unfortunately, when we take a look at total employed persons, we're still below the number of total employed people inside the workforce since before COVID. So the low unemployment rate that's being cited by the Biden administration is arbitrary. It's taking into account people who are in the labor force. There has been a number of people who have left the labor force, and we are still about 600,000 jobs, over 500,000 jobs shy of where we were in February 2020. And when you factor in the population increase over time, really to bring down the real unemployment rate, you would have to have a continuous increase in this total employed. And so we can see the damage that the COVID government shutdowns had on our economy. And in terms of an employment situation, it's been worse than what we had in 2008, though we did have a sharp rebound in the latter part of 2020 that's now beginning to stagnate going into 2022. Looking at real gross private domestic investment, which is the business component of real GDP, it contracted in quarter two after slightly expanding in quarter one. It contracted by a negative 4%, and we would have to go back to 2008 to really see a contraction of the real gross private domestic investment to see another contraction of this outside of what happened during COVID. So the fact that we had a severe contraction in this private domestic investment tells us that we're most likely looking at a real term recession, because that has been one of the bellwether indicators in the previous recession cycles, such as what we saw during COVID, such as what we saw during the 2008 crash and the 2001 and the 1990 and the 1980s collapse. So there have been a couple of situations where we did see sharp drops in real gross private domestic investment for a quarter before a sharp rebound. So it's not a perfect indicator that we're in a recession, but these tend to coincide very much so with a recession. What's driving the gross private domestic is net savings. Okay, so the red line shows net savings over time against a net private domestic investment, which is gross private domestic investment minus the consumption of fixed capital. This gives us a measure as to what businesses are adding to the capital structure in their economy in terms of expenditures to use to expand their production process. The red line is a combination of net savings, that's your private sector savings and your government savings, which is a deficit right now, plus the deposits that are actually in the general treasury account, which can be looked at as a form of savings. And outside of the wild swings that we have been seeing with COVID, this tends to trend very well with net private investment. And that's the reason why, is because the savings is what actually drives the business component of the economy. This is something that Keynesians don't really want you to know. They want to tell you that spending drives the economy, but savings drives the business component of the economy, which is used to produce the final goods that we all spend to consume. One of the interesting factors that has been taking place in 2022 has been this stagnant money supply. So regardless of what one believes about whether the Fed is holding rates too low or pushing them up too high, it's having an effect on the money supply, at least in part. That combined with the general treasury accounts stagnating and accumulating money, cycling that out temporarily out of the money supply before spending it back in. And this depression in the money supply will have a downward pressure, relatively speaking, on prices. Unfortunately, it is countered by the increasing amounts of total debt in the economy, as total debt in Q1 2022 has reached a staggering $90 trillion and will likely push well over $92 trillion in Q2 2022. The reason being, interest rates are so low, and when interest rates are negative and below the inflation rates, regardless of whether you use the personal consumption expenditures chain price index, which the Fed likes to cite, or the consumer price index, or the producer price index, the fact that debt is so cheap encourages people to borrow more, to spend more, and that's likely going to keep price inflation elevated. So even if we see price inflation spike, it's going to take a long, long time before it starts to regulate without sharper increases in interest rates to control this debt increase that we're seeing. Lastly, I want to go over the impacts that these low interest rates had on the stock market right quick. So they have distorted the stock market investment structure to where the stock market is completely overblown to its long-term value, highlighted in green here. And all I'm using this for a measure of the stock market's long-term value is the gross private product. I take the gross domestic product and subtract out government expenditures to give us an idea of the real long-term value of the stock market. In truth, we want to take a look at the aggregate total economy, which is the gross output, and I may replace gross domestic product with past gross output estimates. But for now, it gives us an idea that the stock market is completely distorted, which is the stock market capitalization measured in orange. And what's tending this is because the valuations that the stock market capitalization is following is not its long-term value, but rather its interest rate value, which is what I have in blue, where I use the 30-year treasury rate and combine it with the 5-year GDP growth rate. And taking those numbers and looking at and matching that up together gives us an idea of what the capitalization would be given the interest rate structure, and it tends to follow the interest rate structure very closely for the most part. So right now, we've seen a stock market correction, and if interest rates continue to push up on the long-term spectrum, that should cause the stock market to correct downward even further, but is still grossly overvalued to its gross private product, and this overvaluation of the stock market is depressing alternative investments such as precious metals. Now, what I have constructed here and what I've been telling you guys about is that even though we're probably in a recession, and it's a technical recession, it's unofficially a recession, but it's a recession. It's a contraction of 2 consecutive quarters of GDP. This is not the recession that we should all worry about. This is the recession that we should worry about that can manifest in the coming year or two, depending on how high the Fed raises interest rates. And indeed, when I have what I've constructed here is a debt default model. So I take all the loans that have been made out into the economy and compare that to GDP, and then factor in the Fed funds rate and longer-term interest rates in my new model. And I have discovered a striking correlation that when interest rates reach a certain point with a certain debt level against a certain amount of GDP, then it's too much for the economy to handle. We intend to go through a correction, and we go into a real recession where we see credit defaults start to spike. And we haven't reached this threshold yet. Instead, let me see if I can't pull up the data point of where it is. It looks like where we are is at a ratio of 7, which means we still have a ways to go before we reach up to this 10-point threshold, which would signal a default on the loans. But if the Federal Reserve continues to hike interest rates at the rate that they're going, which is 0.75% every 6 weeks, even if we take a look at the Fed's forward guidance and say that they're going to end up at 3.5% by the end of 2022, if they continue to hike interest rates, and if they hike interest rates up to 4%, if the federal funds rate reaches up to 4%, factoring in long-term interest rates, that could be devastating for our economy if the Fed keeps rates elevated above 4%. And what we may see is a manifestation of rising delinquencies and defaults, much like what we saw in COVID, much like what we saw before 2008 and 2001 and 1990s. And I fear that the recession that would come would be more akin to that of 2008, unless the Fed decides to reverse course and try to stimulate growth in the economy through making debt cheaper and by growing the money supply, but then that will result in another bout and another round of inflation. So our economy is really stuck between a rock and a hard place. We're faced with high inflation and we're faced with high debt with cheap interest rates. Something's got to give. If the interest rates get too expensive, then the debt becomes too expensive to hold. The economy crashes. If the Fed decides to resort to printing money to stimulate growth in the economy, that will result in higher inflation, which might inflate away the debts, but now we're all facing higher prices and a lower standard of living. So the future is looking bleak right now, and even though the stock market has been going through a rally as of recently, as I've pointed out before, the stock market is really overvalued compared to its long-term value, and if we see a total collapse in the economy, evidenced by rising delinquencies and defaults, which we're not seeing yet, and that's no surprise because we have not reached that threshold yet on my default rates model, and I'll pull that up right quick. Once we reach that threshold on the default rates model, then we should start seeing a rise in delinquencies and defaults on loans. Once we see that rise in delinquencies and defaults on loans, that will signal the real peak to the stock market and a sharp correction downward to its long-term value, which right now the stock market is grossly overvalued by at least 2 to 1, could be even 3 to 1. So that's a real problem that we're probably going to face sometime in late 2023, maybe 2024 or 2025, depending on how high the Fed raises rates and how long they keep those rates elevated. The longer that they keep the rates elevated above 4%, the greater the likelihood that we will see a breakdown in the economy. If the Fed decides to try to juice the economy by lowering interest rates back down, it risks another bout of inflation and we go into another cycle again and again. Guys, as always, I thank you for watching my content. If you like what I produce, make sure that you show me some support, like the channel, subscribe, like the video, subscribe to my channel if you haven't already. Click that notification bell so you're always notified when I do upload new content. And as always, I'll talk to you next time.